High dividend yield payers perform poorly in share price terms. Childcare costs fall, but there's doubt over whether it will last. And one of the world's biggest property companies collapses. Welcome to Fear and Greed Business News, Australia's best business podcast. It's Tuesday, the 30th of January, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, after the show today, you have an interview coming up with David Prentice, who is the Managing Director of Brookside Energy, and this is a fascinating conversation.
And very timely, given what's going on in oil markets at the moment. Now, Brookside Energy is an oil junior. It operates out of the US, primarily based in Western Australia, listed on the ASX. We talked to David about how is it that a company like Brookside Energy can find, drill for oil, sell it, when you're up against the Exxon Mobils of the world, Shell, Total, all those sorts of guys. And I asked him to give me a 101 on oil, and that's right from how you drill oil to where they sell it, how these juniors operate. It is a fascinating 101 into the oil sector. In fact, I would say it's one of my favourite interviews so far this year, just because I learnt so much and David put it so clearly.
You know what it is, Sean?
What's that?
It's another must listen.
It's the must listen. Absolutely.
So far, we've had 2 from 2 this week that are must-listen interviews. It's coming up after the show. It is a cracker of a chat, though. The main story this morning, Sean, some of Australia's biggest dividend payers over the past year are also some of the worst performing in terms of share price growth, providing a warning to investors.
Plenty of investors look for dividend yields, particularly pensioners. The banks are well known as decent payers of dividends, but if the value of a share, the share price, is falling, it's easy to lose any dividend gain via what's known as a capital loss, a loss in the share price. Based on market index data using dividends paid over the past 12 months and the current share price, coal companies Yancoal and New Hope, Myer Holdings and Cromwell Property Group have provided some of the highest dividend yields on the ASX 200, but all their share prices stumbled over the past year, from 10% down at Yancoal to 46% down at Cromwell. Most of the top dividend payouts are fully franked, meaning taxpayers can claim a credit, but some, including Cromwell, are not. You need to factor that franking into the mix. There are some stocks that have paid out high dividends and experienced capital growth. Liberty Financial's one, so too Dalrymple Bay Infrastructure, but those dividends aren't fully franked. If you're looking for larger, less volatile companies with both growth in the share price and income and good dividend payouts, then refiners Ampol and Viva Energy are the standouts over the past year, as is Super Retail Group and Fortescue. All those companies also have 100% franking. The point here is that you may be chasing dividends, but keep an eye on what's happening on the capital growth side, because at least over the last 12 months, the big dividend yield payers didn't do so well in terms of share prices.
So, Sean, I suppose the moral of this tale is that when investing, don't just rely on dividends or capital growth for that matter.
That's right. The data from 2023 shows that paying out large dividends mostly doesn't equate to a strong performance by a company. It's a bit of a chicken and egg, because a falling share price makes the dividend yield look better. But when investing, people need the whole story. What's happening with dividends? What's happening with growth? What's happening with franking? We always say get some professional advice, and that should be part of your investment process. And certainly remember what happened last year. So these companies we're talking about, well, it doesn't mean it's going to happen next year, but it is a very cautionary tale for investors to be wary.
All right, let's take a look at local markets. How did things go yesterday?
The S&P ASX 200 closed up 0.3% to 7,578 points, inching towards a new record. Michael, about 2/3 of the companies on the bourse rose, led by the energy stocks and the real estate investment trusts. Worst were the tech stocks, following a sell-off on Wall Street over the weekend. Among the large caps, National Australia Bank led the banking sector, jumping more than 1%, though it had plenty of friends. The big miners were mixed. BHP was down 1.4%, while Fortescue Metals Group was up 1%. James Hardie was among the best of the large caps, up 3.4%, while WiseTech Global in Xero both fell more than 2%. Auto parts retailer Bapcor is expecting a slip in profit in its upcoming half-year report, but investors like what they heard. Its share price rose nearly 6% yesterday, the best on the day. The worst on the day was Gold Road. Its share price tumbled 18% after a disappointing quarterly update, with production lower due to delays accessing higher grade ore from its open pit.
Okay, and what about international markets?
Well, oil prices are on the rise. That's why everyone must listen to the interview with David Prentice immediately after the show, where we're talking about oil. Basically, there's been separate attacks by Iran-backed militants killing US troops in Jordan. More on that in a moment. And another one hit a fuel tanker in the Red Sea. Brent crude reached almost $85 a barrel after the attacks. The tanker is consequential, as shippers have previously assumed the safe passage of vessels tied to Russia and China after earlier assurances by Houthi militants who mostly targeted ships linked to Israel, US and the UK. The fact that they've spread beyond those countries has certainly thrown a scare into that industry. Now, Brent crude jumped 1.5% yesterday. Last week it was up 6%. We're going to see that at the petrol bowser over the next few weeks. Otherwise, gold's up a bit, so too cryptos, while the Aussie dollar, just like yesterday and the day before and pretty much the week before that, is buying just under 66 US cents.
Oh, nice to see it being consistent there, Sean.
Did you know the Aussie, I don't have the numbers in front of me, but the actual currency, it shifted like less than 1% last year. So, take 1st of January to the 31st of December. It was almost exactly the same. And in terms of trading, it was one of the narrowest sort of range of trades that the dollar, we should call the dollar the dozzer. I like that.
The dozzer. That is the most Australian kind of abbreviation for a currency.
The Aussie dozzer.
The dozzer.
So the dozzer traded in an incredibly narrow range. Like there were a few spikes and plunges, but mostly it was in like a 4 or 5 cent range the whole year, which is very, very narrow.
It certainly is. So 1% really then across the year. So you would say then the amount that you complained then before you went overseas last year is certainly out of proportion then to the amount that was actually traded last year.
Yeah, totally. Totally. If I got any trips this year, I'll be doing exactly the same thing.
Oh, something for us all to look forward to. We'll be back in a moment with the rest of the day's business news. Sean, the great tax sale, or the selling of the proposed tax changes, continued yesterday with Federal Treasurer Jim Chalmers stepping up to the pulpit. One thing, though, that he was definitive on is negative gearing, and that is here to stay.
Sure is. He said the government is not contemplating or considering resurrecting the policies it took to the 2019 election. That was the election that they had in the bag, and Scott Morrison somehow won, in part because of the fear campaign around negative gearing. Instead, the focus when it comes to tax and housing has been on incentivising build-to-rent properties with the tax breaks, according to Mr. Chalmers, or Dr. Chalmers, we should call him. Also yesterday, Assistant Treasurer Stephen Jones was out and about, appearing on Sky News to spruik the government's changes to Stage 3 tax cuts. He said the revised tax cuts have gone down well so far with voters. And Senator Jackie Lambie urged the Liberals to, quote, smarten up, end quote, do a deal with Labor. Otherwise, the Greens would have greater ability to push the government to go even further. So what Senator Lambie says is Labor and the Libs should get together to make sure there are no further dilution of those Stage 3 tax cuts, particularly to high-income earners.
Sean, the cost of sending a child to daytime childcare fell by an average of 11% after larger subsidies took effect last July, but the relief might be short-lived.
A year-long Australian Competition and Consumer Commission inquiry released yesterday found that historically, when subsidies increase, out-of-pocket expenses decline initially, but then tend to revert to higher levels. Bad news. Fee increases erode some of the intended benefit for households over time. That's basically what the report found. It also said that most childcare businesses do not appear to be making excessive profits, and the government's reforms had reduced out-of-pocket expenses for all types of care and for households across the income spectrum. So the report found that outside school hours care fell by 8.8%, for example. In-home care was down 12%. Family daycare was down 13.8%. The Watchdog's final report made 8 recommendations and 31 findings, including that the government should consider setting up a market steward, like a horse race, a steward. Anyway, a market steward to oversee and monitor outcomes in childcare markets and respond when they're not achieved. Protest. Sorry. I think the idea of a steward, the only people that have stewards are horse races, aren't they?
Oh, definitely on ships, isn't it? Sean, one other thing that you said just then jumped out at me, and it wasn't really anything of substance. But
well, it doesn't narrow it down very much. Go on.
That certainly came out the wrong way just then. But when you refer to out-of-pocket expenses, I mean, you and I refer to out-of-pocket as being kind of expenses that you kind of have to pay yourself, obviously. Yeah. But are you aware of the fact that Gen Z has an entirely different understanding of the term out-of-pocket?
What do Gen Z thinks out of pocket is?
No, out of pocket apparently just means like out of character, going crazy, kind of bit wild, kind of all that kind of thing.
Really?
Yeah, and it is starting to kind of crop up in various places. And it is really, really off-putting for anyone that's kind of older than Gen Z to suddenly see out of pocket being used in a different context and with a different meaning. It's taking me a little bit of time to adjust.
I have Gen Z kids. Out of pocket to them is anything that I don't pay for.
Okay, ask them once they wake up this morning, go and ask them.
So we've still got at least 4 hours. Yeah. I will. I'll ask them, what's out of pocket mean?
Yeah, absolutely. And you will see that there are two meanings and only one of them now relates to money.
I'll report back.
Okay, back on topic now, Sean. Woolworths says its New Zealand business and Big W discount stores are trading worse than expected, and it will take a $209 million loss on its shareholding in Endeavour Group.
Yeah, so the New Zealand business just isn't working as well as expected, and earnings are forecast to be about 40% below last year. The Big W business, kind of the same deal, is expected to be materially down. The retailer also has a 9.1% interest in Endeavour. Now, Endeavour, of course, owns Dan Murphy's, a bunch of liquor stores, hotels, that type of stuff. It was spun out of Woolies. Essentially, that write-down reflects a different accounting treatment. Let's not get technical here. In fact, we can get someone else to get technical. But basically, Woolies is saying we don't have a lot of influence over that company anymore. Therefore, we are writing it down. All up, though, you put all that together, New Zealand, Big W and Endeavour, it's $1.7 billion of write-downs. A lot of money.
Wow. Suncorp has warned of a jump in home insurance claims and higher costs of settling older car insurance claims.
Yeah, really interesting this. Insurance is a very weather-dependent industry, and Suncorp said the wild weather since last November has largely eroded the better weather earlier in the financial year. That's led to a jump in home insurance claims. Its net damage bill from natural hazards in the 6 months to the end of December was $568 million, including $212 million from East Coast storms last month alone. Now, it sounds like a lot. It's actually lower than its internal budget of $680 million. Cyclone Jasper striking North Queensland will cost Suncorp about $56 million. The other interesting bit in this is the higher car claims come from prior years. It's basically taken a long time for people to get their car repaired. That's not the individual's fault. It's actually supply chain issues, that type of stuff. So they haven't had to pay it out, and now they do have to pay it out, but it just goes to show if you had a damaged car in the last 12 months, well, it took a long time for it to get fixed.
Oh, that is a good story. Former Labor MP Greg Combet, who previously was Climate Change Minister, is going to replace Peter Costello as Chair of the Future Fund.
The climate change job makes his appointment extra interesting because Federal Treasurer Jim Chalmers has suggested the superannuation sector should play a more active role in funding the energy transition. Now, the Future Fund isn't the superannuation sector, but it is a big pool of money. Chalmers said it's important for the Future Fund to get fresh thinking and leadership. Mr. Combet has been chair of the government's Net Zero Economic Agency, responsible for ensuring an orderly transformation to a zero-carbon energy system. He was previously chair of superannuation industry fund-owned IFM Investors, a trustee of Australian Super, a climate and industry minister in the Rudd and Gillard Labor governments, and, of course, a trade union leader. Good luck to him.
It's quite a CV, isn't it?
It sure is. He is pretty impressive, Greg Combet.
Indeed. Now, the South African owners of Country Road Group, whose fashion brands include Country Road and Witchery and Mimco, have warned that near record low consumer sentiment and the weakest household savings rate since the global financial crisis has worsened the outlook for retailers.
Sellers of fashion and apparel are also being hit by a switch in consumer spending away from goods and towards services. In a trading update provided to the Johannesburg Stock Exchange, Woolworths Holdings, which has nothing to do with Woolworths in Australia, Woolworths Holdings revealed almost a double-digit slide in sales for its Australian retail fashion arm, according to a report in The Australian. Trading conditions in Australia and New Zealand have deteriorated further, it said, with consumer sentiment low and household savings weak. Sales for Country Road Group fell by 5% over the 26 weeks to December 24, but were down almost 10% on a same-store basis.
Okay, turning to international news now, and a big story globally, Sean. Chinese property giant Evergrande will go into a liquidation, throwing the all-important real estate sector in China into turmoil.
China's nationwide property debt crisis has claimed its biggest victim, and now the group will have to be carved up and sold off. The company has about $500 billion of liabilities, and after failing to agree with creditors after years of negotiation, trading in shares in the Hong Kong Stock Exchange were suspended yesterday. They dropped about 20% and then they were suspended. The first real trouble occurred back at the end of 2021 when Evergrande defaulted on a bond payment. The process has been long. It has been a big part of the China slowdown story. Evergrande, as well as other developers, overbuilt and overpromised, taking money for apartments that hadn't been finished and leaving hundreds of thousands of home buyers waiting on their units. Dozens of these companies have defaulted, leaving the government frantically trying to force them to finish the apartments, putting contractors and builders in a tough spot because they haven't been paid for years either. The fallout from this will be enormous.
It certainly will. Now, the US President Joe Biden faces growing pressure to confront Iran directly after the country's proxies killed 3 American soldiers in a drone strike in Jordan over the weekend.
Bloomberg is reporting that it is clear that the strike, which also wounded at least 34 people, will force a stronger response from what the US has done so far in the weeks since the Hamas militants' attack on Israel on October 7. Iran said it had no connection and had nothing to do with the attack. That's according to Iranian media. The US doesn't believe it. It says Iranian-backed militants attacked troops stationed in the northeast of Jordan near the Syria border. It's a very, very serious situation.
Yeah. Now, last one, Sean. Yesterday we talked about how well Microsoft is doing. Another of the big 7 tech titans on Wall Street, Tesla, isn't having quite as good a time of it.
No, so far this month, Tesla's share price has fallen 26%. That's about $200 billion off the valuation of the EV company. That is well and truly more than the whole value of BHP.
That's huge.
Well, it's more than the value of National Australia Bank, ANZ and Westpac combined. Don't feel too bad for Elon Musk, because Tesla's share price is still up about 60% since early January last year. But it has now dropped for 6 weeks in a row, the longest streak since 2016. The 2 main reasons is that the market for EVs is soft, as demonstrated by Hertz's decision to sell part of its EV fleet, and Tesla's been cutting prices, which, when you cut prices, ain't that good for profits. So, big sell-off in Tesla shares.
Indeed. All right. Up next is the Fear and Greed Daily interview. You're speaking today, Sean, to David Prentice, Managing Director of Brookside Energy.
Very nice fellow, David. All about oil markets. We get a 101, how they work, how oil's priced, how a junior like Brookside Energy can compete with the ExxonMobil, Chevrons of the world. It is a fascinating interview.
Yeah, this interview is just out of pocket. So I don't even know if I'm using that correctly.
Out of pocket. Yeah, right. Maybe. So that's what you meant. Like, out of pocket means really good.
Well, I mean, it's like it's a bit loose, it's a bit wild, which doesn't actually describe the interview anyway, because the interview is actually really good and very kind of topical. I just wanted to try and squeeze in a mention.
Yeah, no, that's good. That's out of pocket thinking.
There we go. Goodness me, you're already better at using the new lingo than I am.
Yeah.
Well played, Sean. Thank you very much.
Thanks, Michael.
It's Tuesday, the 30th of January, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X and Facebook. I'm Michael Thompson and that was Fear and Greed Business News. Have a great day.